You diversified. You bought IT. You bought banks, maybe autos, maybe mid caps, and today everything failed. So tell me honestly, was that diversification or just false comfort? This is where most investors misunderstand the risk. Because when one sector falls, that's volatility. But when multiple leadership sectors fall together, that is breadth damage. And by the end of this video, you will understand why breadth collapse is more dangerous than the index fall, what it signals about liquidity, why diversification sometimes fails, and what smart investors watch before things get worse. Do not skip the middle section, that is where the real warning is. Most retail investors believe if I diversify across sectors, I am safe. But diversification only works when sectors behave independently. When IT falls, but banks rise, you are cushioned. When autos fall, but FMCG stabilizes, you are balanced. But what happened recently? IT fell, banks weakened, autos slipped, midcaps dropped. Even defensive didn't hold strongly. That is not rotation, that is just correlation rising. And rising correlation is silent risk. So, why does the correlation rise? When markets turn the risk off, liquidity doesn't exit one sector, it exits the market. Foreign investors reduce the exposure broadly, funds de risk the portfolios, hedge funds trim leverage, and when liquidity tightens, everything moves together. Correlation increases during stress. That is a structural behavior, not emotional coincidence. And here is the key part, when correlation rises, volatility expands faster because there's nowhere to rotate safely. This is the part what most people ignore. Breadth collapse often happens before deeper corrections. Let me explain. If the index falls but breadth is strong, it's localized weakness. If index holds but breadth weakens, that's internal damage. Internal damage is more dangerous because the surface looks stable, but underneath the participation shrinks. Shrinking participation becomes a rally sustainability. And here is the uncomfortable truth. Strong rallies need broad participation. Weak rallies survive on few leaders. And when leaders fall too, momentum disappears. So why does it feel different? Usually, one sector carries confidence. But right now, IT is fragile, banks are hesitant, mid caps are under pressure, autos are soft. If leadership is fading across categories, now that signals caution, not panic, caution. And markets move slowly into danger. They don't collapse instantly. They erode first. Erosion feels boring until it becomes visible. Now, the real question, is this a temporary correlation spike or a structural risk building up? So, there are two parts to it. One is that the liquidity will stabilize, support levels will hold, sector rotation returns, correlation drops, and recovery builds. Coming to the second part, the breadth will continue weakening, lower highs form, leadership fades, and volatility expands. So, what's the difference? Follow through. What's the next 3-5 sessions? If recovery lacks strength across sectors, risk remains elevated. If the breadth improves with bounce, stability returns. Breadth leads the direction, not headline. So, what smart investors actually watch? They track the advanced decline ratios, sector participation, volume behavior on down days, leadership strength. They don't just stare at the Sensex points because index hides weaknesses, breadth exposes it, and exposure precedes the damage. If this video made you slightly uncomfortable, good, because investing isn't about comfort, it's about awareness. Most investors look at price, you look at structure, and structure whispers before the price screams. If you want market signals decoded before they become the headlines, subscribe.